Retail investor. Retail investors are regular individuals who buy and sell investments using their own money. They are the most common type of investor in the market today. In the past, investing was mostly limited to wealthy people and large institutions, but online trading apps made investing far more accessible. Retail investors can invest in stocks, bonds, crypto, real estate, and many other assets. Some invest casually, while others spend years learning how markets work. Institutional investor. Institutional investors are large organizations that invest huge amounts of money. This includes banks, pension funds, insurance companies, and mutual funds. Because they control massive portfolios, their decisions can move entire markets. Institutional investors often have teams of analysts, economists, and fund managers studying investments full-time. Their influence has grown steadily over the decades as financial markets became more connected around the world. Value investor. Value investors look for assets they believe are priced lower than their true worth. They usually focus on strong companies that may be temporarily overlooked by the market. Instead of chasing trends, value investors prefer patience and careful research. This style became especially famous through investors like Warren Buffett, who built his reputation by buying solid businesses and holding them for many years. Growth investor. Growth investors focus on companies expected to expand rapidly in the future. These businesses often reinvest profits back into development instead of paying dividends. Technology companies commonly attract growth investors because innovation can lead to huge increases in company value. Growth investing became especially popular during the rise of internet companies and modern tech industries. Dividend investor. Dividend investors prefer companies that regularly pay cash dividends to shareholders. Their goal is often to create steady passive income over time. Many dividend investors choose mature businesses with long histories of stable earnings. Utility companies, banks, and consumer brands are common examples. Some investors even reinvest their dividends to gradually grow their portfolios faster. Income investor. Income investors focus mainly on generating reliable cash flow from investments. While dividend stocks are popular among them, they may also invest in bonds, real estate, or other income-producing assets. This approach is especially common among retirees who prioritize steady earnings over aggressive growth. Stability is usually more important to income investors than rapid market gains. Long-term investor. Long-term investors buy assets with the intention of holding them for many years. They believe markets generally grow over time despite short-term crashes and uncertainty. Instead of reacting to daily price movements, long-term investors focus on bigger trends like economic growth, innovation, and business expansion. This approach is often considered less stressful than active trading. Short-term investor. Short-term investors focus on taking advantage of market movements over shorter periods. Some hold investments for weeks, days, or even hours. They pay close attention to news, trends, and market momentum. Short-term investing can offer faster profits, but it also carries higher risk because prices can change very quickly. Day trader. Day traders buy and sell assets within the same trading day. Their goal is to profit from small price movements happening over minutes or hours. Modern technology and online brokers made day trading much more popular than it once was. However, it requires constant attention, quick decision-making, and strong emotional control. Many beginners are attracted to day trading, but it is also one of the riskiest investing styles. Passive investor. Passive investors prefer a simple strategy that requires minimal buying and selling. Instead of trying to beat the market, they usually invest in index funds or ETFs that track entire markets. This approach became widely known through the popularity of low-cost index investing. Passive investors often believe consistency and time matter more than constantly predicting market movements. Active investor. Active investors frequently buy and sell investments in an attempt to outperform the market. They study financial reports, economic conditions, and industry trends to find opportunities. Active investing demands more research and involvement compared to passive investing. Some investors enjoy the challenge of trying to stay ahead of changing markets and business conditions. Risk-averse investor. Risk-averse investors prioritize protecting their money over chasing large returns. They usually avoid highly volatile investments and prefer safer assets with more predictable outcomes. Government bonds, dividend stocks, and savings products are often attractive to this type of investor. Their mindset is heavily focused on stability and reducing the possibility of major losses. Aggressive investor. Aggressive investors are comfortable taking higher risks in pursuit of bigger rewards. They may invest heavily in fast-growing companies, emerging industries, or volatile markets like cryptocurrency. Younger investors sometimes adopt this approach because they have more time to recover from losses. Aggressive investing can lead to strong gains during good markets, although downturns can be severe. Angel investor. Angel investors provide money to startup companies during their early stages. In many cases, they support businesses before banks or large firms are willing to take the risk. Some angel investors are wealthy entrepreneurs who use their own experience to guide new founders. Successful startups can generate enormous returns, but many early-stage businesses also fail before becoming profitable. Venture capital investor. Venture capital investors are firms or groups that invest in startups with high growth potential. Unlike angel investors, venture capital firms often invest larger amounts of money into companies already showing signs of expansion. Technology startups commonly receive venture capital funding. Over time, venture capital became one of the driving forces behind major companies in Silicon Valley and other tech centers around the world. Index investor. Index investors build their portfolios around market indexes like the S&P 500. Instead of picking individual companies, they invest in large collections of stocks representing broader markets. This approach offers diversification and lower management costs. Many investors choose index investing because it is simple, efficient, and historically reliable over long periods. Like and subscribe for more simple finance explainers. Turn on the bell so you never miss a new video. See you next time.